Okay, good afternoon, everybody. I'm very happy to welcome you to the 2020 GRESB Real Estate Results. And this is co-hosted by GRESB and by Evora. I would like to welcome all the panelists, the presenters, and all the attendees to this event. My name is Josine Peek. I'm head of EMEA at GRESB. And let me briefly walk you through the program. We have two presentations, one at the beginning and one at the end of this event. The first one will be Kevin Kirkby of the real estate team at GRESB. He will talk you through the actual events, the results of GRESB. Then we have a panel on asset level data and CREM and how that interacts and how that will work with the rest of the industry. And then we have a second panel, and the first panel will be led by Eric Landry of GRESB, and the second panel will be led by Philippa Gill of Evora, and that's on technology. Then we will end with the presentation by the EU regulation specialist of INREF, Bahar Selik. And she will really focus especially on the SFDR, which is the disclosure, the mandatory disclosure regulation coming from the EU. And that will be, then we will wrap up also with questions on that. So I would just like to give you one housekeeping rule, if I may. The program is quite tight, so we're not going to have a lot of time for interaction with you. So we would like to ask you to put your questions, to type them in the Q&A section of the Zoom call. So not on the chat, but in the Q&A. And then these will be answered by the real estate team. And Roxana Isayu, our director of real estate, will be there as well to answer these questions. Most of them will have to be answered by text, but some of them we might be able to pick them up and make sure that we can also talk them through in the program. So please keep your questions coming, but do them in the typed form. And now I would like to hand over to the co-host of this event, Evora, Ed Gabitas.
Great, thank you, Josine, and welcome everyone. On behalf of Evora, welcome to this GRESB EMEA results event. I'm Ed Gabitas, a co-founder and executive director. Evora is a sustainability consultancy focused on the real estate industry, currently with offices in the UK, sort of Germany and Italy. As is the current norm, it's a shame we can't all be together, but I'm delighted that there are over 500 people registered for this event. I'm pleased that everyone can join remotely and, more importantly, safely. Evora's purpose is to accelerate the evolution and adoption of real asset sustainability. And it's something we've been passionate about since our inception 10 years ago. And GRESB has a very similar vision. Now, they've been helping capital markets and investors to make decisions that support more sustainable outcomes since their inception. And I think it's fair to say we're all getting used to shockwaves in 2020. And true to form, GRESB created another one with a significant change in the methodology and scoring for the 2020 assessment. And I think those drivers for change were very simple and something that I support, and I think the industry more widely supports. And that's a need for a greater focus on performance and the need for higher quality asset level data. And I see data as being at the heart of performance and risk management, and it will increasingly play a vital role in investment management. And I'm very much looking forward to today's sessions, which are all highly relevant to the use of data to enable those informed decisions. There's an increasing need, in my opinion, for data to be forward-looking, or predictive, to accurately quantify risk and, where relevant, identify actions required to mitigate or adapt. And this is very much a process that Evora and our clients are using, as there's increasing recognition that climate-related risks are considered alongside other sort of mainstream risks. But with that forward-looking message, I'll pass over to the GRESB team for some backward reflection on what happened in the 2020 assessment. Thank you.
Hi everyone. I'm Kevin Kirby, and I will be giving the 2020 GRESB results. And bear with me 1 second while I pull up the presentation for you. All right, this should be up and we're ready to go. So thanks, Josine and Ed, for the introduction. Good afternoon to everyone. I'm really happy to be here presenting the 2020 results to you. We're excited to kick off this year's 2020 GRESB results, representing an incredible group of managers and investors making up the ESG benchmark for the real estate industry. So this is just a program slide we'll skip over. Really taking a step back here as to why GRESB exists. 11 years ago, APG, PGGM, and USS came together to design a real estate survey. They wanted more transparency on ESG performance of their investments and more engagement with their managers. What started in 2009 has led to an entire industry coming together to develop a common language and consistent approach to measuring and reporting on ESG performance. Today we have over 120 plus investor members representing, over 28 trillion in US dollars assets under management. And they're encouraging their managers to report to GRESB, which results in the real estate and infrastructure benchmarks. At the end of the day, GRESB is here to represent the interests of the institutional investors and what they deem as material ESG issues when it comes to assessing performance of their holdings. Through our data, investors can make better informed decisions, engage with their managers to advance the ESG agenda, and ultimately meet the goal of the Paris Agreement and EU goal of carbon neutrality by 2050. Looking at participation, one of the better things to come out of 2020 is a sizable jump in participation in the GRESB real estate benchmark. Overall, we saw a 22% increase in participation. Even in light of COVID, managers were able to rally the troops, collect performance data across the globe from assets and portfolios in 64 countries, including deep coverage across Europe. We have 1,229 entities that submit their data to GRESB, of which half are coming from Europe. And last year, Europe alone had a 24% increase in submissions, which can be attributed mainly to managers submitting additional entities for increased coverage within their overall larger portfolios. We have a number of managers participating with 15, 20, 25 plus entities, and it's great to see the depth and commitment from these managers to report. Specifically looking at Europe here, we're predominantly seeing European participation from the UK, followed by Germany and the Netherlands. Interestingly, in Germany, we had an almost 100% increase in the amount of participants, which is up to 44 this year. And across some of our less represented markets, such as Italy, Spain, and Ireland, we saw anywhere between 50 to 100% increase as well. Looking at sectors, so property types that the benchmark has covered this year, in Europe, the plurality is coming from diversified portfolios, followed by roughly equal shares between 12 to 15% for office, residential, and retail. Here we're looking at the global map. So what we're seeing here is the breadth of the GRESB real estate assessment. Each of these green dots on this slide represent assets at 4.8 trillion in US dollars. In Europe, we have roughly 40,000 assets as part of our database. While not all of these assets are reporting performance data, let alone 100% data coverage, this builds a really solid foundation at which we can prescribe insightful information, advanced analytics, all relevant to asset performance. Looking at value in, across the globe, 2 trillion is roughly coming from the Americas, 1.2 trillion in Europe, and in Asia, we actually have 1.1 trillion, which saw the largest increase in overall value year over year. Now we'll take a look at the actual 2020 results. So this will be a heavy focus on the real estate benchmark, meaning the management and performance components. As you're all aware, we split the real estate assessment into three main components for 2020, the management component, performance component, and development component. And management performance make up the real estate standing investments benchmark, which we'll mainly be talking about today. We will have a couple of points on the development benchmark later on in the presentation. And in addition, we'll be posting, additional insights, analytics to our website, highlighting the 2020 results in the coming days. Here, we'll start with a score overview. This is the GRESB model. For many of you, this is a very familiar graph. We've been generating this graph year over year, and in the end, it's really the crux of our assessments and what it represents. On the y-axis, we have the management component, and on the x-axis, we have performance. Management being 30% of the GRESB score, performance being the remaining 70% of the GRESB score. While the axes have changed due to the restructuring, what hasn't changed is the dynamic benchmarking that GRESB has introduced over the past few years. So in the middle, you can see the global average, and in the GRESB green. Europe and Americas is actually a little less than the global average, but they are making up the vast majority of the benchmark. Oceania, again, is leading the pack as it has been for several years now, with Asia doing quite well from a performance perspective. Also on this model, you'll see the quintile lines, which represents basically the ratings you get for your portfolio. So this top right quintile would be GRESB 5-star entities, and the bottom left quintile would be GRESB 1-star entities. You'll also notice in this graph a bit of crowding along the top line, which is really showing that entities can achieve a score of 100 in the management component. So you really see this crowding towards the top. But from performance, there's a much larger distribution of entities. In addition, we don't want to make a comparison directly to the 2019 scores because of the assessment restructuring, and we'll talk about why in a couple more slides. Just to quickly touch on some of the country averages within Europe, looking at the same model, we can see Sweden, Norway, and the Netherlands above the pack. And you can also see UK has done quite strong when it comes to the policy management component, and maybe more restricted from performance perspective due to data availability from tenants. Great, so here is a contribution analysis, and the idea behind this is to better understand what the actual score increase was year over year, while controlling for changes between the 2019 and 2020 assessments. In making these comparisons between 2019 and 2020 scores, we obviously limited the scope to participants who participated in both years. So that was roughly 900 entities. So we can start looking first at the 2019 score column. Beside that, you'll see indicators removed. So there were several indicators removed, such as data management system, data collection processes, intensities, even incentives for asset level reporting, which led to a net negative impact on the score this year. Meaning that entities actually scored well on these indicators. Next is the reweighting. So this was the restructuring of the assessment into components, with blanket weights of 30 for management and 70 performance. Previously, those weights were estimated to be about 35-75. And so with the increased focus on performance and these quantitative indicators, that was also a net negative impact as well. Next is a newly scored indicator. So there were a few health and well-being indicators that were newly scored, grievance mechanisms, and diversity as well. This led to, it was a net positive, meaning that participants were actually able to respond to these indicators quite well. And lastly, the most interesting metric on here is the ESG improvements column. Because what we're able to do here is by controlling for the other three direct changes, what's left is the actual improvements of portfolios from on an annual basis. Europe leads the pack here with a 5.7 point increase. This could likely be due to many second, third, fourth year participants who are really beginning to fully grasp ESG, how to report, etc. Even back in maybe March, April, we had communicated that there would be a general score drop. But in the end, there was an increase, meaning that the market was able to outpace our recalibration of the scores. So here, performance indicators. So really what the introduction of asset level reporting, what we've been able to show in terms of data analytics. So we're excited to show that Europe outpaces the global intensity average in all main sectors. For assets to qualify for an intensity calculation, it requires both 100% area and time data coverage. In looking at the overall asset counts that actually qualified for intensity calculations in Europe, these increased significantly, meaning and with higher asset counts, that's additional, more granular data to build a better benchmark. So across retail, we had a 30% increase in assets. Office was 10. Hotels increased fourfold from roughly 170 to 600 assets. Industrial as well had a 30% increase in number of assets qualifying for this intensity calculation. Looking at the overall like-for-like reduction is really quite impressive, with Europe outpacing the global average in both energy and carbon. I think as we look forward, energy reduction will be more difficult than GHG, as everyone knows there's a minimum level of energy that has to be used to operate a building, while GHG can continually be decreased until we hit net zero. In the end, what does this mean for performance, how it contributes, how we score performance down the line, and we'll touch on this later in the presentation. So here, and then next we'll just start to talk about some key ESG trends that we've seen from our data in 2020. First, we can take a look at the resilience module participation. The resilience module is an optional module after the main real estate assessment, and it's a set of indicators that addresses the two fundamental categories of climate-related risk, one being transition risk, the other being physical risk as identified by TCFD. Transition risk covers everything from market, policy, legal risk factors that come about from our transition to a low carbon economy so that we can achieve the goals of the Paris Agreement. Physical risks are associated to the acute shocks. We've seen this in Australia with the bushfires and the historic hurricane season in the Atlantic. In addition to chronic stresses, heating and cooling degree days, increased annual participation, things of the like. So really, as evidenced by 2020 participation at the bottom, it increased 70% year over year. Entities are increasingly under pressure to report against these climate risks as they've become universally recognized as financial risks. We've really begun the transition to disclosure requirements, especially in the EU, with the introduction of the EU taxonomy for defining sustainable economic activities and financial products. In addition, we have the impending SFDRs, which impose transparency and disclosure requirements for firms and products. And we'll hear more about this from Bahar from NREV on regulation in the upcoming presentation. Lastly, in 2021, we do intend to introduce indicators from the resilience module into the main assessment as the module has completed its 3-year life cycle. Next, net zero transition. So with pressure from regulation to achieve the goals of the Paris Agreement, the net zero transition is already underway, and we're seeing this with many different frameworks from industry associations taking a science-based approach. We have the World GBC's Advancing Net Zero project, which challenges net zero operational carbon for direct control assets by 2030. And this has almost 80 organizations committed. We also have the BBP's Net Zero Carbon Framework from the UK, with 25 signatories, many of whom already report to GRESB. Interestingly, when we look at GRESB's data, GRESB has a total of only 4 reporting entities operating in net zero, representing 17 assets. So of the 4 portfolios that were net zero based on the reported data to GRESB, Europe has 2 of these representing 14 assets. It's really interesting to see the difference in these being that one entity is 100% covered by renewable energy procurement from the landlord, whereas the other portfolio practically offsets all of their carbon emissions, as renewable energy only covers 8% of the total energy consumption. 2 different approaches, but it's the same finality of net zero carbon. In addition, there are a number of other European portfolios that are within 5 to 7% of being net zero carbon. And interestingly, all of these are relying purely on renewable energy procurement by the landlord and not offsetting the carbon. In Europe, we're definitely seeing more of a trend towards the renewable energy procurement by the landlord, whereas in Oceania, we had this presentation this morning, that was, you really could see that was about half and half, some coming from tenants. We've also seen the Institutional Investors Group on Climate Change releasing their net zero investment framework consultation, in which it highlights the CRIM methodology and recommends its use to determine the alignment of real estate assets with a 1.5 degrees pathway. And for anyone not familiar with CRIM, we'll have an upcoming panel led by Eric and detailing some more about that. Next, embodied carbon. So as part of net zero frameworks, Many first address the need to reduce operational carbon, but embodied carbon assessments and disclosure will become imperative over the coming years. As many people know, I mean, embodied carbon covers everything from raw materials extraction, manufacturing, transportation, construction of buildings, maintenance, and end-of-life emissions. And really, when looking at the overall carbon footprint of a whole building life cycle, embodied carbon can account between 25 to 50% of that footprint. And this is expected to increase dramatically as we decarbonize the operations of those buildings. In 2020, GRESB introduced indicators on embodied carbon in the development component. So we're excited to share the first results at a global level. This graph shows how many development entities actually assess life cycle emissions for the development projects. In the end, Europe, 31% of European development entities assess embodied carbon, whereas looking at the Americas, only 8% are assessing embodied carbon. Oceania had the highest with 42% assessing embodied carbon. But still, you can see that this is still a very new market to begin even to quantify embodied carbon. So overall, as we decarbonize operationally, assessing embodied carbon is critical to achieving the overall goal of net zero. It's a new frontier on how to measure, quantify, and standardize reporting of embodied carbon. So it's a space everyone will keep a watchful eye on. What's next? So where is GRESB heading? Perhaps the most important is measuring true performance. Things we used to do worked well, and now is the time to engage and push the agenda. In this context, GRESB has laid out this 4-step framework that we started a couple of years ago. And many of the performance insights we've drawn in this presentation rely on steps 1 and 2. Looking at step 1, this is data availability, which is the primary condition for measuring performance. You must collect the data in the first place to measure it. And this is an area that's highly scored within GRESB right now. This is granularity, meaning asset level reporting on utility types for different areas within a building. Reliability, so this is third-party assurance, verification, third-party review of data prior to submitting. The second step, looking at data quality, this was the main focus for 2020. So this was quality control. So this was validation checks at the asset level, warnings to show potential errors directly built into the asset portal, outlier detection model. So the outlier detection model this year was done at the asset level rather than portfolio level. And interestingly, in fact, this year we had 56,000 outliers detected across all utility types and data points. Bear in mind, there's thousands and thousands of data points in the GRESB, GRESB platform, but this is still, it's a figure that is basically challenging the data that comes into us, which in the end leads to better data quality down the line. Third step, performance insight is more forward-looking. So we're now working on normalization. So key factors such as vacancy rate, heating degree days, et cetera, and asset level benchmarking. So this is asset analytics from a property subtype benchmarking compared to the way we benchmark now, which is at portfolio level, meaning different property subtypes. And really the last one is benchmarking 2.0. So this is an allocation of scoring weight on true performance and systematic tracking against local and global targets such as CRIM, net zero, SDGs, et cetera. And really to implement some of this transition to performance, we're really excited about the new ownership structure, which allows us to have a fully independent foundation responsible for setting and maintaining the GRESB assessments. The foundation will be led by the foundation board, as well as the former advisory boards and benchmark committees, which will be built into GRESB Foundation. And really the intent here is an independent standard setter, mission-driven, investor-led by the industry for the industry. And we're here to represent the investors. We're investor-led, and this structure allows for increased engagement. With this new governance structure, we have many exciting topics to engage the industry over in the coming period. In the era of digital meetings and webinars, we'll be hosting a series of engagements with both of our, our governance groups, as well as the wider industry, including any participants, investors, and managers willing to contribute. These informal settings can stimulate conversation around the most material issues and create solutions. Collective problems require collective action, and we'll work together to find the priorities for 2021 assessment development and additional topics and products. One being impact of COVID on building performance, which will be introduced in December. A roadmap for defining and benchmarking and measuring performance. Really looking at how we can benchmark and create a residential solution within the real estate assessment. as well as the integration of the resilience module into the main. And lastly, we would typically do this at the end of the event in person with drinks and such. But we're very excited to announce the global and European sector leaders. So here they are. We appreciate the full industry for their leadership in ESG, for participating in GRESB and driving continual improvement as evidenced by this year's results. On behalf of the full GRESB team and wider industry, thank you for your contributions and congratulations. And with that, I will turn it back over to Josine to lead us into the next panel.
Thank you, Kevin. That's great. Yes, thank you very much, Kevin. That was a very, quick but very thorough overview of what you've been doing working so incredibly hard this last year as real estate team. So with that, I would like to, I see a lot of questions coming in the Q&A, which is great, but we're not going to dwell on them. We don't have time for that. I'm going to pass on to my colleague, Eric Landry, who will talk about the asset level data and also, of course, the CREM, so the pathways for the real estate sector.
Thanks, Josine, and thanks again, Kevin, for that great overview. As an introduction, my name is Eric Landry. I'm the climate change specialist at GRESB. And I'll be leading this first panel, and I'll go ahead and introduce our panelists now. So we have Dan Grandage. He's the head of ESG for private markets and real estate at Aberdeen Standard Investments. We have Hans Vrensen, head of research and strategy at AEW Europe. And we also have Dirk Brouwen, professor of real estate economics at Tilburg University and member of the CREM core team. So thank you guys so much for joining us today. And we're going to just dive right in. And I think the first thing, we're going to be talking about both CREM and asset level data today. And so why don't we just hand it over to Dirk up from the CREM team and ask, what is CREM?
What is CREM? Yeah, well, I saw that we have 471 people in the audience, so I can imagine that not everybody is very well acquainted with what we do. It's a new initiative as well, so I can explain it in 1 minute. At least I can try. So what GRESB does is what we just saw in the last 25 minutes. It reports your sustainability performance of last year and compares it to your peers. And I think most people have gotten used to that. And CREM is very similar to that, but it's also different. So CREM is focused on the carbon performance, so not just sustainability, but simply only carbon. And it's really looking more into the future than your past. And we're not comparing you to peers, but with the relevant policy pathway. And so what CREM does and it's an open source freeware package. It's freeware because it has already been financed by the European Commission. So in a way, thanks, you already paid for this. And it's open source. So you can also adjust the settings of the CREM software. And what we do and offer actually are three things. First is we will sketch the policy path that is most relevant to you. So if you're active in the retail market in Poland, we will offer you the policy targets of the Polish retail market for the next 30 years. Or if it's the French office markets, we will do it as well. That's the first step. And in the second step, we will then position your current asset or portfolio in energy intensity, and we will compare this with the relevant pathway of policy. So then we will calculate how long your current property or portfolio is in line with the policy measures. And after the moment that you are no longer in line with that, you will be exposed to carbon stranded asset risk. And that's what we will measure for you. How long do you have until you will reach that point? And then the last and third point, what CREM has to offer is we will offer you the opportunity to simulate actions that you can undertake to extend the framework of being not exposed to stranded asset risk. And to be concrete, you could simulate, for instance, a retrofit, which will reduce the energy intensity of your property. We will help you to simulate that and calculate how many more years you will have before you will then again get exposed to future stranded asset risk regarding to carbon. And that is what CREM is and has to offer.
Great. Thank you for that overview. And I'm just going to flash a couple pictures up on the screen in terms of kind of the GRESB asset performance against the CREM pathways, at least in terms of Europe. So I'm going to go ahead and share my screen here. I hope everyone can see this. Great. So again, so one of the great things about CREM is it downscales these high-level Paris targets in a science-based ways all the way till you get specific pathways at the regional, so at the country and the property sector level. So here we have a bunch of different sectors. You can see by the orange pathways compared against the green pathways, the 2C pathways versus the 1.5, and obviously the 1.5 pathways are going to be a little more aggressive in terms of their GHG intensity reductions than the 2-degree pathways. But if we're just looking at the 2-degree pathways and we're comparing the GRESB performance of our participants who have given us their energy intensity and data, then what we see is this. So again, this is all aggregate up and rolled into one metric of GHG average intensity. And so we see here, again, the 2C pathway and the 1.5C pathway. So again, the crossover point. So this again is filtered down. So only the GRESB participants who have 100% data coverage. So out of these GRESB participants, we can see that they're not on average stranded yet. We have a lower GHG intensity than the CREM pathways, which represent the market overall. However, as time goes on and those pathways decrease quite rapidly, we can be stranded by around 2030 in terms of the 2C pathway, or for those attempting to decrease in line with the 1.5-degree pathway or many net zero targets, then stranding could occur as early as 2027. Again, this is just the average. All of these can be disaggregated into property-specific and country-specific pathways. And so just as an example, I'll break this out into a couple of property sectors. So again, this gives you just kind of a brief overview of the range of, I guess, what we would call stranding dates. So in the solid lines, we have the CREM decarbonization pathways, and in the dotted lines, we have the GRESB performance for their particular property type. And a range of different stranding dates, but we can see even for retail shopping center in particular, so that the very dark lines, it's already pretty much stranded. And then and this is only the 2-degree decarbonization pathway. So as the 2-degree decarbonization pathway decreases over time, the expected performance, if we do nothing, is not slated to essentially keep up with the pace of change that's needed in order to be Paris aligned. So with that, let's get back to our panelists. And so my first question, I'm gonna throw it right over to Dan and Hans. So, is this a transition risk tool, or is this more of a portfolio Paris alignment tool? And Dan, I'll hand it to you first.
Thank you. Good afternoon, everyone. Just trying to check what time it was. I think it's a bit of both, actually. I mean, I think you need to use it to look at transition risks, obviously, to look at how we transition to a low carbon economy. But I think from a portfolio perspective, that's where this really comes into its own. I think it's really quite powerful looking at it from a whole portfolio perspective, being able to look at how the assets perform and identify potential risk areas. What I think it isn't or shouldn't be used for is to target specific assets and trying to hit specific targets. I think it's useful to identify, yes, there is an issue with this asset, and at some point it may become stranded. Personally, I think that it's obviously a forward-looking view, which is good and it's all modelled. But I think to rely too heavily on, say, this asset is going to be stranded in this year is probably a stretch too far. It gives you an idea that probably there is going to be an issue, and we need to address that and understand what's driving that specific stranding risk, if you like. And it may be a data issue, it may be an assumption issue, it may be a performance issue. But I think once you've identified that, then you need to flip to the asset level and actually start to work out what's happening at the asset, what's the actual performance of the asset, what are the targets of the asset, and build it up from that perspective. But it's a really useful tool from an overall portfolio perspective to see the direction of travel. And it's the first tool available, really, which gives you that forward view. Everything up to this date has been backward looking. And so I think it's a positive tool, but I do think there should be some caveats around how it's used, because I don't think it's the be all and end all at this point in time. It has a potential to be, but I do have some concerns how some people seem to be starting to use it in terms of attaching, a huge amount of certainty, and Dirk might have a different view to this, but a huge amount of certainty to some of the numbers. I think it's more an indicative tool for sort of future risks and future issues, rather than that sort of specific target setting tool. Hopefully,
right.
that answers your question.
So maybe not so relevant for a specific asset and ascribing like a carbon price to it and saying this is how much you're going to have to pay in order to. It's maybe not so useful at that scale, but at a portfolio level to go ahead and try and identify where maybe you need more effort.
Yeah, exactly. And to be fair, I don't think this is the CREB haven't stopped. And I think as we move forward through time, I fully expect, and again, Dirk might be able to answer this, that there'll be refinements and improvements to this. And as we move forward time, I suspect the numbers may change and there'll be refinements. And therefore, that's another reason not to rely too heavily on a specific number, because if you start modeling against a specific number to try and hit in 2030, you may find by the time you get there, it's actually a different number anyway. But chances are an asset which is flagged as stranded today will still be stranded, even if CREM change the numbers. So I think it's, you need to have that kind of like health warning attached to that, I think.
Right. No, definitely the pathways, since they're calibrated on forward projections, like, the projected floor area growth in Europe over the next 30 years.
Exactly.
They'll have to be updated again and over time. So it's a bit of a moving target, but, as with all projections. So Hans, what do you feel about the kind of the best practice use of this type of decarbonization pathway? Oh, Hans, I think you might be on mute.
Now,
there we
is
go.
it better now?
Yep.
I think Dan is touching on a lot of good points. I think it's a conversation starter really on an operational level for us. So when we tested the CREM tool, which we've been looking at for some time, and of course, as a Dutch person, I'm attracted to the open source and free nature of the tool more so than anything else. But also, it's science-based and forward-looking. And now, with the link to GRESB, we also find the data upload capability immensely useful. We work with a lot of different standards, and each standard seems to have a different data upload template. That takes a lot of time. And so the link between GRESB and the CREM tool, which basically allows us to take data that we have already given to GRESB to then upload into the CREM tool, that is a fantastic feature. And I think people will be very excited to use that. As far as applying it in the sort of asset management area, that's where we got quite a lot of feedback. And some of it was quite honest. And I think this is why I'm saying it's really a conversation starter. The initial results of the tool showed that we had a number of assets that were immediately stranded. But when you start looking into the reasons for that, you can find specific situations with specific tenant uses of the buildings, etc., as reasons behind it. Again, that is the nature of the tool as it stands today. I think what we can really start looking to do now is to take that feedback perhaps and think about how can we develop a version 2.0 to actually be much more usable for the asset management teams, not only giving them the fact that this asset is going to be stranded, but also working with them, okay, here are the things that you should really be incorporating in the business plan. These are the capital expenses that you should be planning for this type of asset, and you know, who's going to do that, who's going to help with that, and also will the tenants fall in line with that? Because we as asset managers, we don't have control over what the tenants actually do in the buildings, and legally that is a very tough point, because you know, we obviously manage the investments on behalf of our clients as manager, but at the end of the day, the legal requirements for a lease is that a tenant can do with that space what they want. And so there's a lot of sort of practical issues that come forth out of that initial assessment. But the precision, you know, the asset level assessment, that is really fantastic. And it is so much more precise than a lot of other things that we have seen. And so we really hope that there will be more linkages for the CREM tool, not only with GRESB, but with other tools as well. There's no point in having different pathways. We have seen other tools that actually adopt different pathways. I mean, all the work is done. The scientists have spoken, and the Paris Accord targets are very clear. And to have that on a property type specific way in a forward-looking framework is a fantastic achievement. And so we think, and certainly from a research perspective, to have that much more data to work with, and hopefully down the line to also look at more granular data on an asset level basis, that can only be good. Some of these other objections are more practical and can be worked on, I think.
Great. Yeah, no, I definitely agree with you in terms of its kind of legitimacy and credibility is definitely bolstered by the fact that, you know, this was a publicly funded, you know, research, and although it started only kind of constrained to EU countries and commercial real estate, it was so successful in the scope of the project that it actually expanded its scope to cover global markets. So actually, in terms of GRESB, you know, we have over 96,000 assets, and CREM expanded its kind of scope of pathways to cover 98% of them. So not only just global markets, but then also expanding from the commercial real estate sector to also include residential markets as well. So a lot of you know, really great work going on there. I'm gonna flip it back over to Dirk. You know, the CREM pathways, they have 1.5 degree pathway and a 2 degree pathway there. But as Kevin had mentioned during the results overview, there are all of these different frameworks out there. We have the IGCC's framework on net zero. We have the Net Zero Asset Owners Alliance 2025 target setting protocol. We have the Better Building Partnerships framework on net zero. And so, you know, at least the first two have gone ahead and called out CREM explicitly to say CREM is the gold standard. They've really figured out the science-based methodology of downscaling these targets, and so, you know, they endorse the CREM pathways. And so I'm wondering, how can CREM be used to hit these net zero commitments?
Yeah, I think that's a fair question. So let me be frank, we never considered to be in some sort of competition to become a gold standard. It's good that people recognize it as being very useful, but like I mentioned, this is an open source package. And so we will provide people with the best estimate, and like Dan suggested, it will be updated later with new data on the policy pathway that is relevant to you and your home market. And that will be 1.5 degree, 2 degree ready. And you can also even differ from that. The standard will be set for your convenience, but if you differ or you have doubts, you can always override. It's open source. So it's not a black box that you have to trust. So we just offer you a very convenient package with which you can start simulating, and you can rely on the fact that what we set in as defaults has been validated and is reliable. Yeah.
Right. So you can go into the back end and change your
Indeed.
pathway,
Indeed.
your benchmark.
Yeah. There's also another issue that I want to raise, because I've been seeing the chat. A lot of questions have been on the painting. No, it's not the original Lady with the Pearl. So just to get out of that, yeah. Otherwise, I got a lot of burglars here. Yeah.
Great. And so, you know, because CREM really builds up bottom up from asset level data, And Hans, this kind of goes back to your comment on, well, we can't really control what the tenants do with their space. So the CREM tool will go ahead and extrapolate linearly based off of the data coverage that's reported into the tool. And I'm wondering, is that an okay assumption to make? So would you rather have, I guess, a tool that only takes assets with 100% data coverage and gives you kind of a partial portfolio assessment? Or would you rather have an entire portfolio assessment, but with estimated emissions somewhere plugged in?
Well, as a researcher, I'd rather have some assumptions and get a full assessment. So I think, but if your responsibility is to be an asset manager of a portfolio where you have results that maybe kick out some assets where there were quite big assumptions built in, then of course you'd probably feel a little bit different, because those guys take their jobs very seriously. And if they come up with a result like, okay, you have significant stranded assets, but then they walk you through, okay, this is why we have these results, then it becomes a little bit of an operational discussion. But that's exactly the point, right? So you should be having these discussions. And I think in engaging with our investor clients, that is actually what they're also looking for from us. We had one of our investor clients say, hey, listen, we're not looking for a final answer in applying this CREM tool at the moment. All we're really looking for is for you to engage with it, and I think Dirk did a great job explaining it, but the tool is very sophisticated. And I think it could be so that we probably need a little bit more education and training for people in the industry. I hope that it's part of the university program at Tilburg that is being taught to the students, because as real estate professionals, and I include myself in this, a lot of these topics are not something that we learned about in school. It's all new, and we need to pick up the pace on not only teaching ourselves, but also taking our business colleagues with us. And this tool does that, because this is really the alarm that goes off when you start running these numbers, because you will see stranded assets and it will start that discussion. And I think that is the biggest benefit that I see in the short term, is that it does raise awareness. But so I think education and training could be an element that could really further enhance the role that CREM can play as a real application in the industry.
Yeah. So with the last 30 seconds, I'm gonna hand it over to you, Dan, for some closing words to this panel.
Thanks. I agree with him. No, I mean, just to answer your specific question, I think what's really good about CREM is it started the conversation. It is not the finished article, and I think we'll accept that. And I think that's why estimation is fine, because this is the first time we've probably ever, all of us, looked at the whole portfolio and actually accepted, certainly as landlords, accepted responsibility for tenant emissions, and the fact we need to get that. And so having estimations is fine. We have to accept that, and it's allowing us to start to see where the issues are. I think if we waited to have the perfect tool, we'd still be here in 10 years' time. So it's better to start with what we've got, and then we can develop it, as long as we all understand that. And I think that's coming back to your training and education point, Hans, is really key. That actually everybody needs to understand that we're at the start of this journey, and some of these tools are less than perfect and need some improvements. But also we also need to make sure there's some consistent language and frameworks. We've touched on the fact that there's 5-6 different net zero frameworks. They've all got slightly different definitions. Kevin mentioned there's a number of portfolios who are claiming to be net zero. They've done it in different ways. I suspect if they were tested against some of the other frameworks, they might not be able to claim them net zero. I don't know. And I think the sooner we get to a consistent language, the better. And CREM is a really useful way of starting that conversation. That's my 30 seconds, maybe slightly more.
Great. I think that's a fantastic way to end the panel. I'm very happy with it. So and with that, I'll just hand it right back over to Josine. Thank you so much.
Thank you all. That was incredibly interesting and very, very clear. We're running a little bit late, but like 2 or 3 minutes. So I'm going to hand over straight to Philippa from Evora on the next topic, which is technology and how technology can enable the process that we're all in.
Thank you, Josine. I'm just waiting for my video to start. Good afternoon, everyone. What a panel to follow. Thank you all very much for joining us. Now the big question about data, and as we've just heard from the CREM team and users, more data, and this time a forward-looking data. In preparing for this panel, we're thinking of such the enormity of the question of data now. For those of us who've been doing GRESB since its inception 10 years ago, the data challenge grows, and we've just heard about tenant data being critical to the forward-looking part of this piece. So we came up actually with a slightly different question as we look forward another 10 years, lots of challenges to meet for the next 10 years. And we're wondering what we think the balance is between the technology that's now available and human behavior as a solution and the drivers to meeting the next 10 years challenge, which is obviously the enormous climate risk challenge. I have a great panel with me. I have Charlie Jacks from Schroders. I have Emily Hamilton, who is just recently with Savills Investment Management. And also I have Baz, and I'm sorry, Baz, I'm going to pronounce your surname wrong. Baz Blukpoel, in my worst Dutch, who's recently joined GRESB, and I'm actually going to ask him to start with a question because he comes from a non-real estate background, and I think this is going to be a fascinating way as he starts to look at the GRESB data as to what he thinks could be helpful in terms of technology, but also human behavior. Baz, over to you.
Yeah, thanks, Philippa. And indeed, I did join GRESB quite recently, and these are my first baby steps into, let's say, a completely different domain for me, the real estate domain. So very excited to be part of this and to help make the world a better place, if you will. My background is actually from sports data. So I have been working in the sports data industry for 15 years. And I've been working there, let's say, all kinds of data pipelines to, let's say, process the data that is happening on the pitches, on the sports fields, to deliver to media, but also to deliver to sports governing bodies to make decisions on their work. So I see, at least on an abstract level, some parallels with the challenges that are before this group, before this industry. For instance, one of the products that we did was we built out products for the Olympic sports governing bodies, and there was an easy aspect of that, which is difficult here. The outcome of, let's say, what we're trying to achieve there is how many gold medals are we going to achieve as a country in the Olympic Games. That is of course an easy and, in a sense, relatively close by outcome. And but it's similar, I think, to, let's say, meet the goals of the Paris Accords that we've been talking about. So in a sense, it's all kind of following the same guidelines. And actually, I've learned 3 things that are, from a technology perspective, relevant, let's say, for building out solutions which really enable, let's say, decision makers to make the right decisions. And that's, first of all, your data has to be, of course, of good quality and be consistent and comprehensive. And already Kevin touched upon that a bit of in his opening remarks in this session. The second is that the technology should be seamless. Hans commented on that in the previous panel. Yeah, so as long as we have all the touching points where we can ingest the data, work properly and without a glitch, that really enables us to make sure that whole data pipeline is running smoothly. But the most important lesson I actually learned in this domain is that it really comes down to, at what point do you deliver value to the end user? And we found in the Olympic sports domain that the tendency was there to, let's say, over-engineer solutions or to put too much information into the heads of the decision makers. and that would lead to no result. So we found out that by, let's say, building solutions or analytics or insights that were kind of appealing to, let's say, something that could be really made tangible in the daily work, and to make sure that that was delivered consistently over time, that allowed you to then expand, let's say, on that in terms of analytics and forecasting capabilities. And so in essence, the machine should be running good, and then you can deliver on top of that more analysis and make sure that people are using it, collect the feedback, and bring it back into your engine as well. That is what I learned, and I hope to bring as well in this for GRESB for all of you.
Great insights there, Bas. We'll look forward. We'll ask you in a year how your transition is going. Different kind of transition risk.
Yeah.
Charlie, maybe can I ask you next? I mean, you're probably drowning in data right now, but as we look forward into future-proofing and future-looking scenario-based data, where do you see this balance between, the human behavior element is driving change and adding yet more technology into the mix?
Yeah, thank you, Philippa, and Bas too, because I think you made a really good kind of segue into the challenges that we have in real estate. And when we're all striving, to kind of understand a huge proliferation of data and information, we're looking at energy and carbon, we're looking at climate risk and resilience, and we're looking at, health and well-being of people experiencing our places and spaces. And the challenges for us, we've just got so many different stakeholders to actually what a building is doing, for the individuals that are enjoying that experience or they're investing in it and getting a kind of return outcome from it. And that's really the question, is how can we use data and technology, as you're saying, to kind of pinpoint what are the kind of key kind of triggers of information that are going to make the kind of individuals who are responsible for managing a site or for understanding the kind of climate portfolio or climate profile of their portfolios, to really understand, well, what should we be doing, to improve the outcomes for our own beneficiaries? And that's the challenge we have, is how can we use technology to bring back and into kind of the key things that we need to understand, and we can communicate to the stakeholders at those different levels, and to bring about the behavior change to them. What do they need to understand to make a building perform better? What do we need to understand as investment managers to understand the profile of our portfolios? And how can we tell investors how to kind of shape their own portfolios, recognizing the kind of constraints that we have across a kind of very differentiating kind of building stock across the world as to what conditions buildings are in, to really drive kind of climate resilience and better climate outcomes forward. But also, again, I want to come back to this kind of well-being scenario as well. We talk a lot about energy, carbon and climate, but we've got to remember that buildings are ultimately for people, and that buildings are supporting societal outcomes. And we need to kind of bring this kind of well-being dimension to this as well, which is an additional challenge. We've heard about CREM and the way that that is a kind of useful tool in looking at decarbonisation scenarios. But how do we stitch this all together into something that actually enables real estate and buildings to deliver better outcomes, for society generally?
The S question.
Indeed.
How do we do buildings for people? Emily, sorry to put you on the spot. How do we do buildings for people as we go forward, given that we now have a host of new technologies and lots of data, but we still need to put people in? As an engineer that I used to work with said, my buildings would be perfect if only I didn't have to put people in them.
It's a great question. I think Charlie's touched on loads of useful points already. I'd like to add that in how do we make buildings fit for people, we also need to understand how do we make buildings fit for nature and the data we can be collecting for that. So we've already said we've got lots of different data points, but what COVID has shown is that actually spaces that have outdoor access, spaces that are having access to nature, are becoming the spaces that occupiers want a lot more of. We collect a lot of data as an industry on energy, water, waste. We've started collecting data on air quality. I think at the moment, we're probably not collecting as much as we could on green space. And going back to the point of what do we do with that, I think you've seen that we've already got a big demand for better understandings of those spaces. So therefore, it goes back to these critical success factors. By collecting data, we need to be able to do something with it, and understanding what our occupiers want and using market intelligence is one way, but also understanding what the sentiment is of investors as well. And you're seeing more and more there's screenings being done on sentiment as well as hard data. You know, what do we feel about certain companies? And I think that's going to become really important as we start to assess what organizations do other organizations want to work with.
Yes, super interesting. The influence, there's whole PhDs I know have been written on this issue of, awareness. And I wonder, Baz, you've obviously come from a very public facing industry. In terms of understanding how humans use spaces and how the technology interfaces, where do you see the trends in terms of the technology market? In terms, all of us on this panel sit as what I call the fulcrum between huge amounts of data and trying to make that not only accurate, but useful in the hands of the decision makers. Where do you see those trends going in terms of how we can help make sure we've got the right data in the right hands to enable them to make the right decision?
Yeah, well, you see, of course, a lot of energy spent in the world on, let's say, artificial intelligence and machine learning, right? To be able to make more and more sense of all this lot of data. I think also we are at the moment in time where we are being much more cautious about these kind of technologies, and so I think that will also lead us to understand better how we can better deploy these sets of data. And so yeah, that is more or less the trends that I'm seeing in the broader world. You have of course also the Internet of Things that will deliver us even more data, and I think we should just be careful in what kind of data we should be collecting, also in terms of, let's say, the social aspects of it. So yeah, these are the things that I'm seeing at the moment.
Charlie, how do you feel about putting AI across your portfolio data?
Well, yeah, I think we've got a long way to go, haven't we, in terms of understanding how we can get a better process building level data up to portfolios. And I think, to touch on Emily's point, I think sentiment is a really important dimension to this, going back to the kind of the human dimension of real estate. How can we really understand what people are feeling about the spaces that they're in? And then how can we, elicit kind of changes in behaviors of the way that people respond to spaces, and therefore kind of help support kind of better management of the spaces themselves. So, we've got to move towards a kind of smart building technology, but what does that really mean? Because we can have sensors on buildings that are looking at weather conditions and kind of reflecting on, okay, well, the heating and cooling situation needs to be like this, or the sunshine is coming in this way, therefore, put the shutters up, or this many people are occupying this space. So we've got to use that type of information, but then we've also got to understand the kind of the response factor of the people that are actually in the spaces, and saying, well, actually, is the building still delivering the right internal environments for those people to feel healthy and happy in the activity that they're conducting in that space? So it's how do we bring that dimension into it? And that to me is still an unanswered question. We've got certifications on well-being now, but are they really kind of reflecting on the kind of general experience or factor of people over time? So how do we bring that to it all? There's going to be a really interesting kind of set of experiences and research, as you say, in the next kind of 3-5 years, I think, as we try to bring all of this together and make sense of it. We're obviously very much on a kind of climate and carbon initiative at the moment, but we've got to bring this kind of human dimension into it as well.
Yeah, we used to say, if you built a completely net positive building, but everybody hated it, you've kind of wasted the embodied carbon to start with, because it will be empty, which would suggest it's a rather large investment risk to start with. There's something very human about buildings. We all know this, since we learn how to bend the trees and chop them down, make our shelter. Emily, in terms of the challenge of trying to make buildings that are low to zero to net positive, and hopefully at one point to positive energy and other production, how do you've had a lot of focus on the S part of this and the inclusion of natural capital within this. How would you address that as you look at a portfolio in terms of what feedback you want from that and what therefore you can put back into it?
In terms of looking at it from a restorative perspective?
Well, I suppose it's initially a protective, but yeah, moving to a restorative.
I think it goes back to the point we said earlier about making sure you've got the right data to make decisions and getting that data to go up to the right decision makers. So for example, if you're trying to understand what a portfolio, how a portfolio or how your fund is performing, having huge reams of reports isn't always that helpful for fund managers, investment managers. Having a few critical success factors that you can draw out and some metrics that you can draw out to be able to indicate how those funds and eventually how that portfolio are performing is going to be more useful. So I think as an industry, we need to get better and smarter at how we're extracting the data, interpreting it, analysing it. And I think the conversation earlier on CREM and not just taking tools at face value, but actually spending some time to understand how do these tools and how do these outputs actually help us, rather than necessarily here's a number, let's pass it back up to an investor. So I think it goes a lot about the management of that data and being able to use that to then help shape what you're going to be going forward with next.
Great, thank you all. So just as a final thought, as we look ahead, looking ahead 10 years used to seem like a long time, but I suppose as we're managing our portfolios to net zero targets, 10 years seems like tomorrow suddenly. If there was one piece of magic technology that you could put into the buildings that would really move the needle in terms of providing helpful and useful data, and I say that specifically, what would you like to see the industry respond with? What would be the most helpful piece of technology we could really put in? I've thrown this at them, they're all looking at me blankly. Baz, what do you think? You've come from a world of sensors every 2 square millimeters. What would you put into our buildings?
Yeah, well, I'm hesitant to answer with all this knowledge around me, but I guess that it is, again, I think there in, let's say, in energy management, right? In let's say, our lights on, our lights off, and I guess that there's already much to be won there, right? Or am I mistaken there? It seems like to counteract that human behavior with technology, to at least sweep up the low-hanging fruit, seems like something to me. But I'm not an expert in this space.
But Bas, I think what is useful from your perspective is kind of helping us to kind of navigate, what the data challenges are, and having a non-real estate perspective in that, because, we need to kind of look through the weeds and say, okay, well, actually, what are, as Emily says, the critical success factors? And I think for me, one of the, ultimate challenges we have is the individual people running each building. We have portfolios across Europe and into Asia, but every building is supported by a unique set of individuals. So how can we communicate with that individual set of people so that they understand, okay, well, why is their job so important? Why do we want them to look at energy profiles and energy consumption? Why do we want you to make energy efficiency, as good as it can be? How can you engage with the tenants, in that space? Going back to earlier comments, that we can only do so much. It's about the individuals who are using the space every day, which is really going to promote the change that we need. So I think that's the magnitude of the problem. It's how do we communicate with such a vast number of individuals, and how can we bring about a kind of collaborative effort to say, actually, this is really important because, and your role in this is this, please will you help us? And we can reward each other with getting kind of better outcomes by us all working together. So not a technology solution, Philippa, but I think it's a collaboration, a kind of recognition of the collaborative need to try to bring about better change.
I completely agree with Charlie. I think if we can make that data and use the tools we have to make the data visible. So you'll see more and more in really high performing buildings, they're having visual data charts, visual data information, being able to show infographics. You walk into some great buildings and that you can actually see how much is the building using right now. And I think the more you make that data accessible and available to everyone, rather than stored in a portal somewhere, the easier it's going to be able to engage on these issues.
Definitely, we forget we are still mammals, as much as we like to think we're a different kind of species, very sensory, very visual. The more we can put in front of people, definitely the better. In the meantime, I'm going to invent some kind of automatic response system for my son when he leaves all the lights on. I haven't quite worked it out yet, but maybe that's what we need, some kind of electric shock treatment, so he switches the lights off. On which note, thank you all so much for your time and your expertise, and I will hand back to Josine.
Thank you very much, Philippa and Charlotte, Emily, and Bas. That was super interesting. And you know what I reflecting on it, you see more and more we have these enormous collective problems. We need collective action, and we also need some form of collective data. So it's a fascinating time. And with the bridge to the next subject is really that it seems that the European Union has also really understood these problems in the same way. They see the path to transition through transparency. And that's why we thought it would be a good idea to focus on the SFDR or the wider EU taxonomy legislation, but also specifically on the SFDR, which is the mandatory disclosure policy that the EU is now introducing. And we're super happy to have Bahar Selik, who is the expert on this within INREF, with us. Bahar, I'm going to ask you to put your camera on.
Hi everyone. So I need someone to put my camera on, I think.
We see your slides. We don't see you yet, Bahar.
Yeah, I'm not allowed to open my video.
Okay, let's see if Sasha, could you put that on?
Now.
Yeah, perfect.
It works now, perfect. Thank you, Yozin. I'm glad to be here with you all today and happy to summarize the regulation briefly and highlight a couple of key points. So the SFDR Sustainable Finance Disclosure Regulation, it is very important in the sense that it supports a very clear policy goal of encouraging the transition towards a low carbon, more resource efficient and more sustainable economy. But before going deeper with the SFDR, I just want to provide a background information, the context information on the key EU legislative initiatives for ESG. And I will try to highlight the ones that are especially having an impact on the real estate industry. Kevin, can you please go to the next slide, please? Thank you. In terms of the journey of sustainability legislation, after Paris Agreement, which was signed in 2016, European Commission adopted Action Plan on Financing Sustainable Growth in 2018. And now you can think where we are only 4 years later. Now we are talking about the SFDR, the Disclosure Regulation on ESG. We are talking about taxonomy, EU climate transition benchmarks, EU Paris aligned benchmarks. So it is happening remarkably quickly when compared to other regulatory developments. So on the EU side, there is a real push to reach a level of transparency for sustainable growth. I've also added here AFMD and MiFIDs, although their main focus is not specifically sustainable finance. With the latest amendments, we see that they have requirements around managing and integrating sustainability risks into risk management processes. At INREF, we follow closely the regulatory developments on ESG, and we often work on regulatory consultation papers and provide feedback on behalf of our members. And if, for instance, our response to the SFDR Level 2 consultation paper is available on our webpage. If you are interested in more details, I definitely recommend you to take a look at this. And last but not least, we cannot talk about sustainability reporting without mentioning the role of voluntary standards of disclosure, which have been created by non-governmental organizations or intergovernmental organizations or industry participants associations. They are very important in the sense that they provide standards, frameworks, benchmarks beyond compliance with the regulation. And I believe they will continue to be important in the future, but the thing is, they will be more connected with the mandatory reporting, I would say. Next slide, please. So let's go deeper with the SFDR. Who is impacted? The scope is very broad and it covers nearly every sustainable finance product on a cross-sector basis. The legislation distinguishes between two categories of firms. First one is FMPs, financial market participants. Most relevant for of these from a real estate perspective is managers of alternative investments, AFMs. It also covers investment firms carrying out portfolio management, pension providers. It provides a very long list of participants. And the second category is financial advisors. These are firms basically authorized to give investment advice. The regulation affects EU firms and also those wanting to market funds in the EU. So we can say that the regulation is intended to have extraterritorial effect. Lastly, on this, the regulation is extremely important for larger firms. Companies having more than 500 employees will be required to make disclosure with more strict rules. However, some degree of disclosure will be required from all firms that market funds into the EU. Next slide, please. The regulation introduces these are the principal obligations of SFDR, and it introduces new transparency obligations and periodic reporting requirements at both entity level and product level. At the entity level, this is a list of information that FMPs have to publish on their website and maintain up to date. I just want to provide a couple of highlighting ones. I will not go into details. I just want to give you an idea of what is required by the regulation. And the first one you see here is transparency on sustainable risk policies. And the second one is about publishing and maintaining where financial market participants consider principal adverse impact of investment decisions on sustainability factors. If they don't consider adverse impacts, they need to provide reasons why, including whether or when they intend to do this. This is referred as comply or explain approach. But from June 2021, large firms will be subject to mandatory compliance. Actually, this is the main difference between obligations applicable to larger firms and smaller firms. And the last one you see here, the remuneration policies, they should be consistent with integration of sustainability risks. At the product level, for all products, it is required to disclose how sustainability risks are integrated into investment decisions, and assessment of likely impact on product returns should be also disclosed. The SFDR introduces three broader types of financial products with Article 8 and Article 9 products. So with the Article 9 products, we see sustainable investment products. These are products that have sustainable investment objectives. And with Article 8 products, we can call them ESG products. They should promote either environmental or social characteristics, and they need to take ESG criteria into account in the investment process. And the third category is non-ESG, non-investment, sustainable investment products, which are the ones cannot be categorized under first two categories. So the disclosure should be based on these three broader types of financial products. And we have the no significant harm principle, which is very important, especially for sustainable investment products. This is a relatively new regulatory concept. It is a core principle of both the taxonomy regulation and the SFDR. And it refers to having sustainable investment objectives while ensuring that there is no harm on any other environmental or social objectives. The SFDR contains proposals on different levels of disclosures at product level. This disclosure should be on website in pre-contractual disclosure. An example of pre-contractual disclosure could be memorandums, basically, and periodic reporting, which could be a simple example, annual reports. So the product level disclosure should be at these 3 levels. Next slide, please. So in the previous slide, we talked about principal adverse impacts. I just want to provide a little bit background information details on this. The SFDR is it's a high piece of regulation, so it provides the principal obligations. After SFDR came into force at the end of 2019, this year in 2020, 3 European supervisory authorities developed regulatory technical standards, RTS, to clarify the content, methodology, and presentation of ESG disclosure. The RTS shows that what is meant by principal adverse impact, basically. It provides a disclosure template for this. You see here all the indicators provided with the template, and FMPs must disclose their principal adverse impacts on their website using this template. The RTS proposes a list of indicators that would always lead to principal adverse impacts, and therefore that would always be disclosed. So these indicators are mandatory. You see here in the middle line, the dark green boxes, and these are subdivided into 16 environmental and climate-related indicators, and 16 indicators relating to social and employee matters, respect for human rights, anti-corruption, and anti-bribery matters. The RTS also proposed additional opt-in indicators from which financial market participants must choose at least 1 environmental and 1 social indicator to include in their statement. Next slide, please, Kevin. Thank you. And the timeline. So, as I mentioned, the SFDR was published in November 2019, and the 3 European supervisory authorities developed a proposed regulatory technical standards this year. It was open to public consultation. They gathered all feedback from the industry, and the RTS was supposed to be finalized by the end of this year and to be effective in March 2021. However, recently, European Commission postponed the application of SFDR Level 3 RTS, the one that provides the details. They do that in order to provide adequate time for implementation. So there's a delay with the effective date of RTS. Now, it is expected that the regulatory technical standards will be finalized by the end of 2021 and will be effective in January 2022. However, this doesn't mean that there is a delay with the SFDR. This is very important. The European Commission clearly indicated that even without the full RTS, the SFDR will be effective by March 2021. This is for the principal obligations that we talked earlier. And all application dates laid down by the regulation are maintained as it is. Next slide, please. So this was a very high level summary of the regulation. I tried to keep it very short. It is very detailed. Going forward, what is important from the regulatory side, from the regulator, we talked about different ESG regulation coming from EU. There's a clear need for more alignment between different disclosure requirements, especially between taxonomy and SFDR. For instance, the definition of sustainable investment in SFDR, it is, unfortunately, it is not linked to taxonomy. And we hope that there will be more clarification on definitions, on terms used, so for instance, do no significantly harm principle or the product types. And yeah, we hope that there will be more alignment between different disclosure requirements. I'm sure that they received this feedback during the consultation period. So from us, from the industry, as you can imagine, the extent and the depth of the information that is expected. Yeah, what I can say now, we need to be prepared for this regulation now. We need to act now. And I recommend asset managers, fund managers to start thinking about how this applies to you across your business. And it is time to engage with your investors and other stakeholders and think about how you are going to integrate this into your organizations, in your policies, in your existing risk management systems. How do you collect data? So if you already have systems, is it aligned with the proposed regulatory requirements? So we need to think about these items and be prepared now, and the action should be now rather than waiting for things coming to effect. Yes, thank you. Thank you for listening. Yeah, that was very, very short, but I tried to summarize it.
It was very comprehensive, Bahar. Thank you very much for that overview. I see a question from Rox here. What is the source of the principal adverse impact template? Oh, sorry, I think that was one for you personally, Bahar. That's too detailed.
Yeah,
sorry, I started to read it.
Yeah.
We have a couple of minutes. I think one thing I would really like you to reflect on, this is, as far as I know, this is the first time we're getting a mandatory ESG disclosure regulation worldwide. I haven't seen it anywhere else. I heard, I'm just wondering, how do you think that mandatory ESG disclosure will navigate the set of voluntary disclosure regulation that is currently there? How do you see that interplay between these two?
Yeah, it is very important. Thank you for this question. Very, very important point. So we know that it was all started with voluntary disclosure, right? So we had the basis, the fundamentals with voluntary disclosure. As ESG matters have increasingly become the focus of investors, these disclosure standards were developed. We had, for instance, UNPRI, UN Global Compact Participation, CDP, GRI, for our industry, GRESB, best practices. So we have been working on this for a while now. And I see that now we are entering a new era of integration with regulatory reporting, and regulators are becoming more proactive, especially in EU. Yeah, for the future, I think there will be more interconnection with voluntary and mandatory reporting requirements, and they will feed each other to have a more effective way of disclosure, because it is important to have to reach a certain level of standardization in ESG reporting. But we learn from each other. It is very important. We learn from general voluntary disclosure requirements, and I think on the regulatory side, they also learn from voluntary disclosure, as we see now examples with the TCFD reporting. For instance, the UK government decided to add TCFD reporting into mandatory reporting. This is very important. This is very important to have a standardized type of disclosure on ESG.
Yeah, indeed. And then maybe one final question, because I know we're running a bit out of time. But if you look at these metrics, these 32 metrics that are going to be the indicators that the EU wants everybody to report on, are they actually detailed enough in your opinion? Are they good enough to not allow any sort of greenwashing wiggle room to happen?
I think the indicators are very detailed. The methodology is also detailed, but I just want to note that this template is not the final one. We are still waiting for the final template for principal adverse impacts, but I think it has a good balance between environmental and social aspects, and also it provides the details of how to calculate these indicators. So I think it doesn't leave room for greenwashing with these indicators.
Well, great. So the EU is doing a good work here in getting all this data together. through us and through the industry. It will be a lot of work, but I really think it's incredibly important.
Yeah.
I think I'm just going to check if there's any question from the audience. We've had lots of we've had almost 50 questions from the audience, which is absolutely great. There's one, maybe the last one I can pick up. Please, can I request Mrs. Bahar to give examples of Article 9 and Article 8 products? It's a bit of a detailed question. Is there something that springs to mind to you, Bahar?
Yeah, sure. So actually, the Article 8 and Article 9 products were introduced with the SFDR as an idea, but we are still waiting for the disclosure template for this, the details with the RTS. But what could be an Article 9 product? They should have basically a sustainable investment objective. This could be similar to the impact investing and that we are talking right now. So instead of managing environmental and social risks, it is beyond that. It is about having an objective to have a positive impact on environment and social aspects. On the Article 8 products, they look like the products that we are talking with integrating ESG into decision-making processes. So we will learn more about this and we will have a market experience in the future. But I would say that most of the real estate products could be listed under Article 8 ones.
Excellent. So these are like shades of green, and the 9 being the most green of all, with an actual impact. Excellent. Well, with that, I want to thank you and thank everybody very much for being here, and great to see everybody come together like this. Okay, have a good afternoon. Bye-bye.